You spend 30 or 40 years building your retirement savings. You contribute to your 401k, earn Social Security benefits, and maybe you are fortunate enough to have a pension. But when retirement finally arrives, one decision could determine how much of that money you actually get to keep. Which income source should you claim first? Most retirees follow the same default strategy. They claim Social Security as early as possible, avoid touching their 401k, and delay everything else for as long as they can. It sounds responsible, but in certain situations, that order can create a chain reaction of lower lifetime benefits, larger required withdrawals, higher Medicare premiums, and unnecessary taxes. The problem is not always how much money you saved. Sometimes it is the order in which you take it out. In this video, we are breaking down the 3 major retirement income sources, the most common sequencing mistakes, the Social Security tax torpedo, 5 different claiming strategies, and the 2026 tax rules that can affect your decision. Before we begin, an important disclaimer: I am not a financial advisor, tax professional, or attorney. This video is for educational purposes only. Retirement and tax decisions depend on your personal circumstances, so consider speaking with a qualified professional before making major financial decisions. With that said, let's begin. Section 1. The Retirement Income Triad. Many retirees look at their 401k, Social Security, and pension as 3 separate buckets, but they are not separate. They are interacting gears inside the same retirement machine, and each one behaves differently. A traditional 401k gives you flexibility. You decide when to withdraw money and, subject to tax rules, approximately how much to take. But that flexibility comes with responsibility. Your balance is exposed to market risk, and you also carry the risk of withdrawing too much, living longer than expected, or allowing the account to grow into a future tax problem. Social Security works differently. It provides monthly income for life and generally receives annual cost of living adjustments, making it a valuable source of inflation-adjusted lifetime income. But once you claim it, your starting age has a major effect on your monthly benefit. You cannot withdraw 10 years of Social Security in advance. There is no lump of money sitting inside an account with your name on it. You receive a monthly payment based partly on your earnings record and the age at which you begin claiming. Then there is the traditional pension. A pension can create a reliable income floor and transfer part of your longevity risk to the pension plan. But pension rules vary dramatically. Some pensions include inflation protection, while others do not. Some provide meaningful increases when you delay, while others provide little or no increase after the plan's normal retirement age. That is why successful retirement planning is not simply about having these 3 income sources. It is about coordinating them, and this is where many retirees make their first major mistake. Section 2. 5 retirement sequencing mistakes. Mistake number 1 is automatically claiming Social Security at 62. Age 62 is the earliest age most people can begin receiving Social Security retirement benefits, but claiming early comes with a permanent reduction. For someone whose full retirement age is 67, claiming at 62 can reduce the monthly benefit by approximately 30%. That does not automatically mean claiming at 62 is wrong. People with poor health, limited savings, shorter life expectancies, or an immediate need for income may have valid reasons to claim early. The mistake is claiming at 62 without calculating the long-term cost. Suppose your full retirement age benefit is $2,000 per month. A 30% reduction would bring that down to approximately $1,400. That is a difference of $600 every month. Because future cost of living adjustments are applied to that lower starting amount, the gap can continue for the rest of your life. For married couples, the decision can also affect survivor income. So the real question is not, can I claim at 62? The real question is, what am I giving up by claiming at 62? Mistake number 2 is delaying a pension that does not reward you for waiting. Social Security generally becomes more valuable when you delay it up to age 70, but pensions do not all work that way. Some pension plans provide an actuarial increase when you delay payments, while others may provide little or no increase after the normal retirement age. In that situation, waiting could mean giving up years of payments without receiving a proportionately larger benefit later. However, never assume this applies to your pension. Check the plan documents, compare the monthly payments at different claiming ages, Review survivor benefit options and find out whether the pension has a cost of living adjustment. A pension without inflation protection becomes less valuable in real purchasing power over time, so delaying a non-COLA pension may be very different from delaying inflation-adjusted Social Security. Mistake number 3 is protecting the 401k at all costs. Many retirees treat their traditional 401k as untouchable. They claim Social Security early because they do not want to see their investment balance decrease. Emotionally, that makes sense, but mathematically, it may not. Traditional 401k withdrawals are generally taxed as ordinary income. If you allow a large tax-deferred account to keep growing untouched, you may eventually face substantial required minimum distributions. Under current law, RMDs generally begin at age 73 for many retirees, while age 75 applies to certain younger birth groups. The exact age depends on your date of birth and the type of account. The larger your tax-deferred balance becomes, the larger your future required withdrawals may be. Those withdrawals can increase your taxable income, the taxable portion of your Social Security, your Medicare premiums, and the tax rate applied to other income. Deferring taxes can be useful. Deferring taxes without a long-term withdrawal plan can become expensive. Mistake number 4 is ignoring the Social Security tax torpedo. Social Security benefits are not always tax-free. The IRS uses a calculation commonly called provisional income or combined income. The basic formula is your adjusted gross income plus tax-exempt interest plus 1/2 of your Social Security benefits. For married couples filing jointly, the key federal thresholds are generally $32,000 and $44,000. These thresholds are not adjusted annually for inflation, which means more retirees can cross them over time even if their real purchasing power has not increased significantly. Below the first threshold, Social Security benefits may remain untaxed federally. Between the thresholds, up to 50% of the benefits may become taxable. Above the upper threshold, up to 85% may become taxable. That does not mean Social Security is taxed at an 85% tax rate. It means up to 85% of the benefit may be included in taxable income and then taxied at the retiree's applicable tax rate. Mistake number 5 is accidentally crossing an IRMAA threshold. IRMAA stands for Income-Related Monthly Adjustment Amount. It is an additional charge that higher-income Medicare beneficiaries may pay on Medicare Part B and Part D. Medicare generally looks at your modified adjusted gross income from 2 years earlier. So, a large Roth conversion or 401k withdrawal today could affect your Medicare premiums 2 years from now. IRMAA operates differently from ordinary progressive tax brackets. Once your income crosses a threshold, you can move into the next premium tier. Even going slightly above a threshold can trigger the higher surcharge associated with that tier, and for a married couple on Medicare, the higher premiums may affect both spouses. That is why retirement income planning should not look only at federal tax brackets. You must also consider Social Security taxation, capital gains thresholds, Medicare, IRMAA tiers, state taxes, and the effect of your decisions in future years. Section 3. How the Social Security tax torpedo works. Let's put real numbers into the provisional income formula. Imagine a retired married couple receiving $50,000 per year in Social Security benefits. They need another $30,000 for living expenses, so they withdraw it from a traditional 401k. Their provisional income would be calculated like this: $30,000 of other income, plus half of their $50,000 Social Security benefit, which is $25,000. That gives them provisional income of $55,000. Because $55,000 is above the $44,000 upper threshold for married couples filing jointly, part of their Social Security becomes taxable. Using the federal formula, approximately $15,350 of their $50,000 Social Security benefit could be included in taxable income. Add that to the $30,000 401k withdrawal, and their income before deductions could include approximately $45,350. Here is where the tax torpedo appears. While the couple is inside the 85% Social Security phase-in range, an additional $1 withdrawn from a traditional IRA or 401k can cause as much as another 85 cents of Social Security to become taxable. That means a $1 withdrawal can temporarily create as much as $1.85 of additional taxable income. If that income is taxed inside the 12% federal bracket, the effective marginal rate on that additional dollar could temporarily reach approximately 22.2%. That is 12% multiplied by 1.85. However, this effect does not continue forever. Once 85% of the couple's Social Security is already included in taxable income, the additional inclusion stops. The lesson is not that traditional retirement withdrawals are bad. The lesson is that the timing and size of those withdrawals matter. So how should different retirees coordinate their income? Let's examine 5 scenarios. Section 4, 5 retirement income scenarios. These are educational examples, not universal recommendations. The right strategy depends on your health, marital status, spending needs, pension rules, tax situation, investment balance, and life expectancy. Scenario A is the early retiree with a large 401k. Imagine someone retires at 62 with a substantial traditional 401k. The default strategy might be to claim Social Security immediately and leave the 401k untouched, but an alternative strategy may be more effective. The retiree could use controlled 401k withdrawals as a temporary income bridge while delaying Social Security. For someone whose full retirement age is 67, waiting until age 70 can produce a monthly Social Security benefit, roughly 77% higher than claiming at 62. That larger benefit is generally inflation adjusted and continues for life. At the same time, spending down part of the traditional 401k may reduce future RMDs. This strategy may be especially valuable for someone who has a large tax-deferred balance, can tolerate market fluctuations, expects a long retirement, and wants to maximize future survivor benefits. But it is not right for everyone. A retiree with poor health, limited liquidity, or an urgent need for income may reasonably claim earlier. Scenario B is the retiree with a non-COLA pension. Imagine a retiree has a pension that does not receive cost of living adjustments. Because the payment is fixed, inflation gradually reduces its purchasing power. If the pension also provides little or no increase for delaying beyond its normal retirement age, beginning it at that age may be worth considering. The pension could create an immediate income floor, and the retiree might then use a combination of pension income and controlled portfolio withdrawals while allowing Social Security to grow. Unlike the fixed pension, Social Security generally receives annual cost of living adjustments. That can make delayed Social Security increasingly valuable later in retirement. But the pension documents must be examined carefully. A reduced early retirement pension is very different from a pension claimed at its normal retirement age. Scenario C is the high-income retiree with a large pension and 401k. This retiree may have a different problem. They already receive substantial pension income, and they also have a large traditional 401k. If they leave the 401k untouched until RMD age, future mandatory withdrawals could push their income higher. That could increase ordinary income taxes, Social Security taxation, and Medicare premiums. One possible strategy is to complete partial Roth conversions during lower income years. The retiree voluntarily moves money from the traditional account into a Roth account and pays tax on the conversion today. The objective is not automatically to convert the largest possible amount. It is to compare today's conversion tax with the taxes and Medicare costs that may occur later. Before determining the conversion amount, the retiree should model current federal tax brackets, future RMDs, Social Security taxation, capital gains exposure, IRMAA thresholds, state taxes, and the potential effect on a surviving spouse. A Roth conversion that remains within one federal tax bracket can still cross an IRMAA threshold, so tax brackets and Medicare thresholds must be calculated separately. Scenario D is the retiree with limited savings. Imagine someone has only $50,000 in liquid savings. Trying to delay Social Security by rapidly draining that money could leave the retiree vulnerable. One medical bill, home repair, or family emergency could wipe out the remaining reserve. For this person, preserving liquidity may matter more than maximizing the theoretical lifetime benefit. Claiming Social Security at full retirement age, or even earlier when necessary, may be reasonable. Full retirement age is currently 67 for many younger retirees, but it depends on birth year. At full retirement age, the person generally receives 100% of their primary insurance amount. The key point is this: a bridge strategy should not leave you without an emergency fund. Maximizing future income is not helpful if it creates financial instability today. Scenario E is the high net worth retiree with multiple account types. Imagine someone has millions of dollars spread across taxable brokerage accounts, traditional retirement accounts, and Roth accounts. The conventional withdrawal order often says to spend the taxable account first, then the traditional account, and then the Roth account last. That strategy is simple, but simplicity does not always produce the lowest lifetime tax bill. A more flexible strategy may use proportional withdrawals. The retiree could take some money from taxable accounts, some from tax-deferred accounts, and, when useful, some from Roth accounts. This can help manage annual taxable income. It may also allow the retiree to realize long-term capital gains while remaining inside the 0% capital gains bracket. But remember, the 0% rate applies only to qualifying taxable gains, not the entire amount withdrawn from a brokerage account. Ordinary income, including Roth conversions and traditional retirement withdrawals, can also push capital gains out of the 0% bracket. Taxable assets may receive a step-up in basis under current law when inherited. That means blindly spending the entire taxable account first may not always be the best estate planning strategy. The goal is flexibility, not following one rigid withdrawal order forever. Section 5. The 2026 Tax Guardrails. To coordinate these strategies, you need to understand the major tax boundaries. For 2026, the standard deduction is $16,100 for single filers, $32,200 for married couples filing jointly, and $24,150 for heads of household. Taxpayers age 65 or older may also qualify for an additional standard deduction. For 2026, that additional amount is generally $2,050 for qualifying unmarried taxpayers and $1,650 per qualifying married spouse. There is also a temporary enhanced senior deduction available for qualifying taxpayers. It can reach up to $6,000 per qualifying person, or as much as $12,000 for a married couple when both spouses qualify. However, this deduction is subject to income limits and begins phasing out above specified modified adjusted gross income levels. Now, here is an extremely important distinction. The standard deduction and senior deductions can reduce your taxable income and final federal income tax bill, but they generally do not reduce your adjusted gross income. That means they do not directly reduce provisional income when calculating how much of your Social Security is taxable. This is where many retirement explanations get it wrong. A deduction can reduce the amount of federal tax you ultimately owe without preventing Social Security from entering the taxable income calculation. That is why you must separate 4 different numbers: gross income, adjusted gross income, provisional income, and taxable income. They are connected, but they are not the same thing. The Better Retirement Withdrawal Framework. So what should you do first? Should you claim Social Security, start your pension, withdraw from your 401k, or complete a Roth conversion? There is no single answer for every retiree. Instead, ask these 5 questions. Does delaying this income source produce a meaningful guaranteed increase? Will taking income today reduce a larger future tax problem? How will this decision affect Social Security taxation? Could it push me across a Medicare IRMAA threshold? And will this strategy leave me with enough liquid savings for emergencies? The goal is not to minimize taxes in one isolated year. The goal is to create reliable income while managing taxes across your entire retirement. Sometimes that means claiming Social Security early. Sometimes it means delaying Social Security to 70. Sometimes it means starting the pension first. And sometimes it means intentionally withdrawing from a 401k earlier than required. The best order depends on how all the pieces interact. Conclusion: you can spend decades making the right saving decisions and still lose money through the wrong withdrawal sequence. Your 401k, pension, and Social Security should not operate independently. They should work together. Social Security can provide inflation-adjusted lifetime income. A pension can create a dependable income floor. Your investment accounts can provide flexibility, growth, and tax planning opportunities, but only when they are coordinated properly. So before automatically claiming Social Security at 62, Before delaying a pension because waiting sounds responsible, and before protecting your 401k at all costs, run the numbers. Look beyond this year's tax bill. Examine future RMDs, survivor income, Social Security taxation, and Medicare premiums. Because retirement success is not only about how much money you accumulate, it is also about when, where, and how you take that money out. So let me know in the comments, which income source do you plan to use first? Your 401k, pension, or Social Security? And remember, this video is for educational purposes only and does not provide personalized financial, legal, or tax advice. Consider speaking with a qualified professional who can evaluate your complete financial situation.